In this section, I'm going to show you the basics of reading price charts. One of my favorite price charts that I like to use are the candlestick charts, and candlesticks come from ancient Japan when they used to trade rice. So it was rice traders, and it was a way for them to quantify price action visually. So as you can see here, you have a whole bunch of different green candles. You also have a variety of different red candles. Each one of these candle bars represents a different time frame and price. So as you can see up here in this corner, we've got all these different time frames. So right now I'm in the 12-hour time frame. When you see a green candle, it means that the price went higher. And when you see a red candle, it means that the price went lower. Now, if we were to break down one of these candles, you have, let's say on a red candle, for example, the main body right here would be the top, right? This is the open, and it means it closed right here on the main body, so closed right there. And this wick up here, this little wick, is the high, so that's how high it went. And this wick down here is the low. So that's a red candle. Open, high, low, close. And a green candle is pretty much the opposite, right? And sometimes you don't even have a wick. Like in this instant, you don't have one on the downside and you don't have one at the top. So let's look at this one over here that has a balance of the wick. So in a green candle, it means that it opened up lower than where it closed, right? So it opened up here, it had a low, maybe a little bit of a shakeout, and then it bounced, hit a high, and then finally settled down and closed right here. So when you have that followed by another green, it means that the direction has been moving up. So that's individual candlesticks. There's a few things you want to look at when reading price charts. Number one is you want to look at price action. So price action is the direction in which the price is going. So if you have a bunch of green candles, you know the direction is going up, and vice versa. If you've got a bunch of red candles, you know the direction is going down. You want to be able to identify areas of support and resistance. So support is where buyers step in, so you have multiple points of support right here. It came and tested, buyer stepped in, buyer stepped in, buyer stepped in. Resistance is where sellers step in and they push the price down, right? So it's whoever's in control of the market. When sellers are in control of the market goes down. So you can see there's some resistance here. When you break, and then the support and resistance in between these is a range. When you break out of that range, that's called a breakout, or when you break down from that range and go lower, that's called a breakdown. And so you also want to be able to look at momentum, right? Sometimes you can use momentum indicators, which we'll go into later for that. And then number two is volume. Volume is very important, right? Volume shows you how much action there is. I mean, you could get a whole bunch of different candles, but some of them might just be noise, right? So the candles that have really, really big volume show strong price direction, right? Strong action. There's usually the most volatility when there's volume. So these are all the volume candles down here, as you can see, right? And then you also have the prices here on the sides. And so you also have time and sales, so the live executed trades. So over on Coinergy, you just hit this tab right here. And these are the live executed trades right here. So you could see, how much Bitcoin people are buying and selling at any given point in time. And then you have the order book. And these are how much orders are stacked on the book, how much liquidity is on the books, right? Obviously, if you're going to trade on exchange, generally speaking, it's good to trade on exchanges that have liquidity. So you can see all the different orders and prices. So you can see here, someone's trying to buy, a little over 19 Bitcoins. You see them moving at that price, and it shows you the dollars right there. And so this is the bid side of the order book, and this is the ask side of the order book. So, if you're market making, you're stacking orders on the book. So you're putting orders on the book. And if you're market taking, you just immediately buy or sell into orders already on the book. So you market take if you really need to execute a position quickly. You market make if you're trying to get a better fill, either by buying or selling. And then the difference between the bid and the ask is called the spread, right? So the tighter the spread, the more liquid the market is. So as you can see here, there's a spread between 10.2407, 10.2481. So there's a difference here in the spread. Some exchanges have a huge gap in the spread. Some are much tighter. And obviously, the tighter you get to the spread, the better price you're going to have at executing or having your orders filled, right? So these are basically just all the different basics of the charts. And you also have time frames down here, right? So you see 2017, you can see different months. We're in February, different periods of the months. If you want to look at larger time frames, for example, you could look at a month chart, look at the entire picture, right? So each one of these candles would represent a month. So that's it for this section, and I'll see you in the next. Cheers. All right, so here's a tutorial on how to use a trading platform called Qzx900. Qzx900 is one of my favorite trading tools to use. I use it all the time because it has the most cryptocurrencies and crypto markets available. And it's got a lot of similar charting tools that you have in TradingView, except it's more tailored towards crypto, and it's got some other features as well and applications that kind of put it on the next level, right? So if you're really serious about trading crypto, I see this as a must, right? So, as traders, we don't necessarily have a lot of operational costs. So, this is definitely something that you want to get yourself, right? So let me show you some of the things that I like to use in Qzx900. Now, there's a ton of tools and things that you can use in Qzx900, and you could explore this platform for hours. I'm just going to show you the things that are the most important to me when I'm trading and the things that I use the most, right? So right here, you have all the different types of exchanges all on the side here. And what you can do is you can just type in, let's say, any market. So if I put BTC, it'll show me different pairings. So I can, I could look at, let's say, China. I want to see what the Huobi price is over in China, or CNY price. I can just see that. If I want to look at, some of the USD prices, I could go to Bitstamp or Bitfinex and see what the price is there. The two markets that I tend to look at the most are the USD markets and the CNY, Chinese yuan markets, predominantly because they have the most liquidity, right? So you have these candlesticks right here, which represents the high, low, open, and close. And as you can see right here, it'll show you the exact price of each candlestick as you move over them. And I can use a scroll wheel to, to basically increase the size of the sticks, zoom in, zoom out type of thing. Or let's say I want to look at some uncharted price action that I can't see. Like, let's say I was in a trade and I wanted to see, okay, where would the price go if it breaks out? You can go on the side here and you can left click and just drag, right? So you can see multiple different price points and drag it. And if you want to bring it back to its usual, just double click, 2 left clicks right there. You've got all the months down here. Depends on the time frame, so you can look at various different time frames of candlestick charts. So this is a monthly, you can go on a daily, you know, if you want to scalp, you can go on a much smaller time frame, like the 5-minute charts. And there's a whole bunch of various different charting tools as well. So the most important charting tool for me is obviously a trend line, right? Because a trend line allows you to be able to identify support and resistance, identify where the trend's going, things like that. We're going to get into more of that in another section. So to set a trend line, what you do is you click on this, you left click, you drag, and then you left click again. And that just kind of anchors it. And then you can move this around, right? And you can shrink it, you can extend it. There's other types of charting tools as well in here, a whole bunch of different ones. Another one that's kind of generally good is just having an arrow. You know, if you want to point at something, right? So, you know, that you can kind of treat the charts like a bit of a science and an art, right? I mean, there's definitely some principles in trading and technical analysis that people generally follow. But you know, you can have your own interpretation of those principles, right? So it's not like anything's written in stone. You can point to certain things, you can say certain things. If you want to write something, so let's say I wanted to point towards this volume increase right here. So you can see all the volume bars. You can click this A over here, so left click, and then you left click down here, and then I can write something like volume increase, right? So I can point that out. You know, I can change the size of the fonts right up here, change the color, so you can kind of decorate the chart any way you want. Let's say I want to just delete everything that I wrote. I can just right click, and then I have all these other options, and then I can do remove all indicators or remove all drawing tools, or both, all indicators, drawing tools. Now you also have these other patterns here. My favorite out of all of these is head and shoulders, which we'll get into later, but you can draw out various different types of patterns. So again, you just left click it. So if I were to look at, let's say, 3-day chart, oops, you know, if I wanted to draw a head and shoulders somewhere, I could just do that, you know, maybe somewhere here. And you know, these don't have to, and we're going to get into the head and shoulders pattern later. Well, here's one potential example, just a small one right here. So I'm just basically left clicking, right, to anchor everything. And then if I want to delete it, I can just right click on it and then just click remove, or you know, I can clone or copy it. So I'll just remove it. This tool is interesting. You can really calculate your risk to reward with this tool right there. So let's say I were to catch a breakout right here, and we're going to get into breakouts in a bit in the next section. And let's say I set a target, you know, at prior resistance, and I set a stop below support or whatever. So it shows that this is kind of like a 3-to-1 risk to reward ratio. You know, I could lose 12% of my trade and make, you know, 37% on this if it goes according to plan, right? And you know, you could do the opposite. So you can also do short position as well, right? So if I wanted to short and set a stop above resistance and then set a target, you know, let's say there's a trend line here and I want to set a target, I could do something like that, right? And this would give like a 6-to-1 ratio. So it'd be a good trade entry. And then you have all these tools right here. And again, I'm just showing you the ones I like to use. You can explore this and, tailor a specific trading strategy that suits you and technical analysis. But you could do all kinds of stuff, if you want to really make things interesting for if you're sharing a chart, and put some smiley faces or whatever. You can expand it by grabbing on that or shrink it. You can stretch it. You can, do all kinds of stuff, right? So get creative, explore. Some other things that you'll want to look at is you can set alerts. So, and you could set SMS alerts, like text alerts, as well as alerts for your email. So let's say I have an alert. Okay, I wanna see where this breakout is. So I just clicked on that alert button, and it's like whenever the price breaks out above this area, I want to be notified. I want to know that there's oops, what happened there? Actually, let me set that up again. All right, so yes, you can just adjust your alert. Okay, so let's look at here. Let's say it breaks out above the all-time high. I can pull this up and look, you could just see an alert went off. Set above the all-time high, and then boom, confirm alert. So if we break out the all-time high, I'm going to receive a text, and then you could set all of that up over in the setting or the alert section and such. And there's a whole bunch of other different tools that you can use. There's a bunch of interesting apps that are very specific to Qzx900. So, I showed you in another section, but we'll look at this again, the arbitrage matrix. This is an application that'll just kind of show you all the different arbitrage opportunities, which we'll look at later. So basically just looks at the price differences between various different Bitcoin exchanges. Other apps that we have is you can look at, Block Explorer. So Block Explorer is just Bitcoin transactions. Oh, sorry, it's coming soon, so that's not available yet. Newswire. So this kind of shows you all kinds of various different news events. They have Google Sheets. And there's SMS alerts and such that I was talking about before. So let's just see what the Newswire looks like. So if you want to stay on top of, fundamentals as far as news is concerned, this just kind of gives you a conglomerate of consolidation of all various different news stories that were released recently. So it could be like your one-stop news feed if that's what you're into. If you're into looking at news, and you could actually trade directly through Qzx900. Now, I don't do this, but you could manage multiple accounts, and they'll give you a tutorial as well, right? Like, so they'll explain everything for you if you want to just go through another tutorial if I missed something in this section. But you could add new exchanges and wallets and stuff. Now, if you're going to do something like that, you definitely want to make sure you activate two-factor authentication, and then it'll show you your balances and such if you're trading. But I don't use that section. I just predominantly I trade directly on the exchanges. So I use this mostly for charting. And another really interesting feature with this is, let's say you want to share a chart, right? So if you're on social media, if you want to share a chart on Twitter, you could do something like, so let's say I were to draw out some trend line here. Just as an example, you just click on this right here. It takes a snapshot, and it'll generate a link for you. So then you just copy link to tweet, or copy link, sorry. And then it'll show you copy to clipboard. You could tweet it out directly too from here. I'll just give you an example. If I paste this, it'll basically show you your charts, right? So that's a much quicker and easier way of sharing your charts with people, so you don't have to, take a screenshot and crop it and all that kind of stuff. So yeah, so this is just some basics with Coinigy. I highly recommend you explore the various different tools and optimize it so that it's right for you. And we'll see you in the next section. Cheers. All right, so before you start trading, it's important to realize that trading is a zero-sum game. What that means is that for every winner in the market, there's also a loser, because traders are competing with each other to make money in the market. So as a new trader, your first goal should be survival, so that you can actually get enough experience in the markets. And one of the biggest mistakes that new traders make is they get too greedy too soon. They see dollar signs and then they make very costly mistakes that knock them out of the game early. So you want to make sure that if you're new to trading, you want to practice with small amounts, or if you're experimenting with a new trading strategy, make sure you get enough experience in your belt and make sure the strategy works before putting real money on the table. Now, not every single situation in the market has to be a zero-sum game. Sometimes there are win-win beneficial transactions that happen in the markets. For example, traders do provide liquidity. Miners and merchants need the markets to be able to cash out coins to pay for operational expenses. And perhaps even long-term investors or day-to-day users might just need to buy or sell Bitcoin. So you can have some win-win situations in the market. So in order to stay in this game for the long haul, it's really important as a trader that you develop a solid risk management strategy, because trading and cryptocurrencies, they both come with high risk and they can lead to financial loss if you're not being careful. You can't always win in the markets. It's not possible as a trader to always win. So the traders who stick around long enough, they tend to minimize losses and maximize gains. And this is the formula for staying profitable in the markets. And one of the ways of doing that is to acknowledge the risks ahead of time and make a plan before executing on any trade. In order to make a solid plan and be objective, it's always important to look at both sides of the market so that you also understand the risks ahead of time. So here are 6 rules to manage risk. Only trade when you have an edge in the markets. One of the biggest mistakes that traders make is they overtrade in the markets. When you overtrade, you're going to pay more money in fees, and you might trade more emotionally and actually end up chasing the markets instead of just trading when you have an edge, right? You don't want to trade in choppy market conditions or when you have a 50-50 coin toss. You want to trade when you feel that the probabilities are more in your favor. Always make sure that you have a plan. Never just trade randomly without first cultivating a solid plan. And again, when building a plan, you need to look at both sides of the markets, and position sizing is very important. So you don't have to go all in on the first trade. You could actually scale in incrementally if a trade is going in your favor or cost average down. And if you are margin trading and using leverage, it's important that you don't go overkill on the leverage. There are places where you can go up to 20x or 100x on leverage size, but the more leverage you use, the higher the risk is of having your account wiped out. And always make sure to have an exit strategy in case a trade is working against you. Security is the most important element for managing cryptocurrency. Crypto allows you the freedom to be able to control and access your money at any time. But with freedom comes responsibility, so it is a double-edged sword. You are absolutely responsible for the security of your own private keys, because whoever gets access to the private keys of your crypto will be able to steal them from you and get ownership of it. So having private keys stolen is actually one of the biggest security risks in crypto. And one of the ways to mitigate this risk is to use a hardware wallet such as Trezor or Ledger Nano. The thing that I like about using hardware wallets is that it gives you the ease of using a web wallet, and yet the security of cold storage, which is isolating your private keys from the internet so that they become unhackable. For any of your online accounts, it's always important to use two-factor authentication. What this does is it acts as a secondary passcode. You can use an app such as Google Authenticator to be able to generate that. And if someone steals your password, then they actually need to get access to your phone as well to be able to get into your account. For passwords, you want to make sure that you use nice strong passwords that have at least 16 characters with a mix of numbers, letters, capitals, and symbols. Protect your primary email or the email that you're securing your accounts with. Two-factor authentication as well, because if someone hacks your email account, they could reset a lot of your passwords. And make sure that you use Google Authenticator, a special app for 2FA, and not just an SMS text. The reason being is that a lot of hackers have socially engineered their way into people's phone accounts through their phone service provider. So make sure that you call up your phone service provider and have some additional security questions and maybe a PIN code to be able to access the account so that somebody can't pretend that they are you. Counterparty risk is also a big problem in crypto. We've seen many huge multi-million-dollar hacks, such as Mt. Gox and various other exchanges have gotten hacked, as well as going bankrupt. So as traders, we can't help but have some money on an exchange because that's how you trade and make money. But there are ways to reduce counterparty risk. So rule number one is never keep all your coins on an exchange. It's always important to keep the majority of your coins on cold storage and just trade with the percentage of your coin on those exchanges. And then whatever percentage you have, let's say you allocate about 20% of your crypto portfolio towards trading, take that capital and divide it amongst several exchanges. So I generally like to use 5. So if one exchange goes bankrupt or gets hacked, then even my trading capital isn't completely wiped out. And anytime I use a new exchange, I always make sure to properly vet it. So you can do some research, see if the exchange is in good standing. Oftentimes there's warning signs where people will start complaining of the inability to withdraw their coins ahead of time before an exchange goes bankrupt or gets hacked. So make sure that the exchange is in good standing. And sometimes exchanges that are in good standing get hacked anyway, so just acknowledge the risk and plan accordingly. Alright, so in this tutorial I'm going to show you how to use Poloniex. Poloniex is one of the biggest altcoin exchanges around, and they also tend to determine price discovery for some of the top coin markets. So the first thing you're going to want to do is click on this tab to create an account. Put in your name, your country. You don't have to give your phone number. You could give your email address. Make sure that you're using an email address that's not public, just for extra security. Strong password. You want to make sure you use at least 16 characters with numbers, letters, capitals, and special symbols, things like that. And then you'll have to verify your email. They're going to send you a verification code, and you just click on it to verify your email. Alright, so once you're logged in, the very first thing you're going to want to do is set up two-factor authentication. This is extra security, so what you'll do is you'll download an app called Google Authenticator, and then you scan this QR code and it'll generate a special code for you that you'll have to confirm with your password and code to enable it. And what this does is it secures your account, so if someone cracks your password, they need to actually get physical access to your phone and get that secondary passcode that'll get generated. So let's look at trading and some of the trading options. So you have various different tabs here. You have exchange, margin trading, and lending. So under exchange, these are all just spot markets. So as you can see here, you can see all the different types of markets here. You have the coin, so this is the abbreviation of the specific market. So this would be Monero, Dash, Ethereum, Golem, Ripple. You have the price. The price is all measured in Bitcoin value, at least for this exchange here. You can get prices pegged to the US dollar using Tether, also known as USDT. but you definitely want to trade on markets that are the most liquid. So obviously there's some liquidity here for Bitcoin and such, but some of these other ones aren't as liquid. The majority of the most liquid markets where price discovery is determined are generally paired against the Bitcoin markets. So it'll show you the volume. This will show that Monroe traded over 4,000 Bitcoins in trading volume, so several $1 million. It shows the price paired in Bitcoin. It'll show you the percentage change, 24-hour percentage change. And this isn't always accurate. I've seen times where it wasn't accurate, but for the most part, it'll just give you a quick overview and then the full name of it. So let's say I wanted to purchase a coin. Let's go with purchasing some Ethereum as an example. So we have the order book here. We have the buy orders. It shows the buy support. So there's over 1,000 Bitcoins in buy orders. So these are the bids and these are the asks. These are sell orders. This is the amount of Ethereum that people are trying to sell. And as you can see, the markets and the price are moving quickly. As I scroll down, it'll show the market depth between buys and sells. It'll show my open orders on the books. It'll show the trade history so you can watch the order flow of trades being executed. And you can click on this for my trades. Now, I don't have any trades because this is just a demo account. But what I do have is I did deposit just a couple of dollars of Bitcoin just to show you how to execute a trade. So I'm just going to be doing a market trade. So I'll just pick a price down here. And it'll give me the best fill for the price. Now I can only trade what I have in my account, which is a couple of dollars. And that'll allow me to buy 0.16 of Ethereum or Ether. And it executes immediately. So that's a market order. I could do the opposite too. I could just set a sell order. So let's say I want to sell it for more expensive. Let's say I want to sell it for 15 instead of 12. Then I can just put down the amount that I want to sell it for and how much I want to sell. And that'll just stack an order on the book for me. So as you can see here, my open orders, it shows the price I want to sell at, the amount, the total Bitcoin that I would get out of that trade. And if I want to cancel it, I just hit cancel. And so now you also have stop orders, right? So let's say I wanted to get stopped out of a trade. All right, so to set a stop, I put the stop price where it gets triggered. So if the market moves against me to 0.011, right? So if it drops, then it'll trigger my stop, but it'll set a limit, and this is for slippage. So if you have like a large order, you want to set a limit. It'll sell up to this price, and then it'll show amount. In this case, it's only a small amount, so it would likely execute immediately. But so that's the difference between just setting the stop where it triggers and the limit fill up to this price. So it's showing me if the highlight bid drops to or below 0.011, in order to sell 0.165 ETH at a price of 0.01 BTC will be placed, right? So that'll ensure that my order gets executed with the least amount of slippage, because sometimes if the market's moving fast and you have a big dump, your order might not get executed at all. So that's what that stop limit is for. So I'm just going to cancel this. And I'll show you how to transfer funds. So now that's exchange, and you could trade on the Ethereum markets, the Monero markets and the USDT, but I like to just stick with the Bitcoin markets because they're the most liquid. So if I want to transfer balances between exchange and margin, for example, I just click on transfer balances. I just have to do agree. All right, so click on that, exchange to margin. Actually, let me do Ethereum since there's more. All right, from exchange to margin. And now I just go in the margin trading tab. And I have various different markets. Not every market that they have is available for margin trading. So what margin trading is being able to use my base as collateral to be able to borrow more coins, right? So I have up to 2.5x leverage, so I can borrow 2.5 times my deposit, right? And what that deposit does is ensures that the market cannot move past a certain percentage. If it moves against me by a certain percent, then I'll get liquidated and lose that deposit. And this ensures that the swap lenders, which are the people lending the coins, will always get their money back. As long as the exchange stays solvent, they don't have any risk on the line from traders taking risky trades. So I'm going to show you how to short Ethereum. So shorting is just borrowing Ether and being able to sell them on the market. And so if the market moves down against me, then I can buy back those Ether at a lower price. The swap lender gets back their principal with the interest, and I get to skim the profit in between where I sold and where I bought back in. So if I want to sell and go full size, I just click on that, and let's just pick a price that'll get me filled at, and then margin sell. Okay, so it's saying my collateral, I don't have enough collateral for that size. So let me reduce the size here a little bit. Sometimes you have to just kind of do this in increments. Even though it's telling me I have that much ETH, sometimes you need to do it in increments. It won't allow you to execute it all at once. So let's just short sell 0.11 ETH. So as you can see here, it says I've sold this amount of ETH, and the order was placed and executed. So it shows that I'm short, tells me the amount that I'm short, tells me the base price, the estimated liquidation price. So if the market moves up to 0.026, which is pretty far away, then I would lose everything in my account and get liquidated. It shows me my unrealized profits and loss. So I'm starting off at a negative by 954 Satoshis. And then it'll show the unrealized lending fees. And this is just, this is basically just the fees that I have to pay in interest for borrowing the coins. So now that I shorted, let's say I just want to set an order on the books to close me out once it hits a certain price. So let's say if it falls to 0.010, for example, I want to close out and take some profit. What I will do is I'll just set a buy order for the amount of ETH. So it would be 0.1105 2320, and I can just set a buy order. And so what that'll do is it creates like a one cancels the other, OCO. So as soon as the price hits that value, it'll close out my order and profit automatically. So I don't really have to pay attention. Now, I could set a stop as well. If I don't want the market to go against me, I can set a stop exactly the way I demonstrated before, right? And let's say I just wanted to close out quickly out of my trade. Then all I have to do is hit close right here. And it just closes me out. And that's that. So that's how you short an altcoin. And longing is just the opposite. You just buy. Now I'll show you one last thing with Ethereum, which is the swap lending. So again, I'll have to transfer balances. And so I'll go from margin to lending and then transfer. So if I look at the lending, I could see BTC lending. So people are lending Bitcoins. This is the rate. So they're offering loans for, this is daily interest. So they're offering loans at 0.0196%. So with compound interest, obviously that could add up. If you're okay with the counterparty risk, you could just do lending, which is less riskier, and just earn some passive income on your Bitcoins. And if I wanted to lend Ethereum, there aren't any loan demands on the table, so I would have to just make an offer and then set it up for the amount of days. And if I do auto renew, it'll just keep on renewing every 2 days. And I could put any amount of days that I want. Obviously, you know, someone here's got 2 to 10 days. And then it puts my offer up. So if I wanted it to get lent out immediately, I would give a reasonable offer that surpasses everyone else's offer so that it gets scooped up a lot quicker. For the most part, sometimes if one of these markets are in high demand, like if they really rally and they're illiquid, sometimes the loan offer can go up quite significantly if people want to short it and there's not a lot of demand. So you can actually, if you see one of these markets pumping, then you can buy some coins and then lend them out so that people can short. But obviously there's some risk because if the markets crash on you, then you can lose money. And that's why the percentages are much higher when people want to borrow and the markets go parabolic. For the most part, the most stable way of doing this is just through Bitcoin. And you can go here. So now that you know the 3 elements of this exchange, you can look at deposits and withdrawals. So this will show you everything you have, and you can basically, you know, deposit any coin you want. So if you wanted to deposit BitShares, for example, you know, it'll generate a code. If I want to withdraw, then, you know, same thing. I have to put in the address. In this case, there's a memo that comes with the address, the amount, withdrawal. Then it'll send you a verification email and also ask for your 2-factor authentication. And that's important. You want to make sure that you do that. And then you can also look at your history. So it shows the deposit withdrawal history. I can look at trade history and analysis. So it'll just show me all the trades that I just took. And it'll show you all your trades. So if you need to calculate, you can look at it by dates and you can add your coin and such. So if I were to look at Ethereum and analyze, it's showing that I have a loss of 0.0019, which I actually don't think is very accurate because that's all I have in my account. So yeah, I'm not sure if their trade history section is quite accurate at calculating this, but you'll have all your raw history right here. So that's it for this Poloniex tutorial, and I'll see you in the next video. Alright, in this tutorial I'm going to show you how to use BitMEX. BitMEX is a Bitcoin and crypto derivatives exchange. It allows you to be able to trade futures contracts on Bitcoin as well as a handful of various different altcoins. So the very first thing that you're going to want to do is register an account. You produce your email, strong password, country, and first and last name, and then the CAPTCHA. Now, this service isn't available to US citizens as a result of regulation, so make sure that you're able to trade on this exchange through your local jurisdiction. So this is just a demo account. I deposited a couple of dollars worth of Bitcoin to throwaway address. And the interesting thing with this is that you can only deposit and withdraw Bitcoin. So although you've got all these other cryptocurrency markets, Bitcoin is always used as your base collateral. So the very first thing you're going to want to do is set up two-factor authentication. And you do that by going here, click on account and security. Then where you see enable two-factor authentication, you can choose a type. So in this case, I'd choose Google Authenticator, which I highly recommend. And then you download the app on your phone. You take a picture of this QR code. It'll generate a code for you and you hit submit. And what this will do is it'll generate a secondary password for you. So if someone cracks your password, they need physical access to your phone to be able to generate that secondary password and get access to your account. So once that's secure, then you can deposit money into your account. So you just click over here under the deposit address and you can just copy and paste this and send it from your wallet or take a picture of the QR code. Once the money, it takes about one confirmation for it to show up in your account. And as far as withdrawals are concerned, for extra security, they only process withdrawals once a day and they do it manually for extra security. So let's look at some of these contracts and how you can trade some of them. So my favorite contracts here are the Bitcoin contracts. Now, you have ones that are called perpetual swaps, which are considered daily contracts. You can go up to 100x leverage, so you can go up to 100 times your deposit account. These contracts are very simple. Every single contract is worth about $1 worth of Bitcoin, right? And the reason why these are called perpetual swap is because there is a maintenance fee every 8 hours that needs to be paid to either longs or shorts. And you can see the funding rate down here. It'll show you the funding rate. When it's in the positive, it means that longs, people who bought Bitcoin or bought contracts, end up paying. So it's in 3 hours that expires. You'll end up paying people who went short, right? And when it's in the negative, it means that people who shorted, which just means selling contracts, will have to pay people who went long. And oftentimes you'll see this, you'll see longs pay shorts more often than not, but there are times where shorts have to pay. The reason being is because in order to be short on Bitcoin, you're still using Bitcoin as your base collateral, right? So let's say you're only short 1x leverage. Well, that would just be a hedge, and you'd just be locking into dollar value with exactly what you have in your deposit account, right? So if the price goes down, you'll still have the exact same amount of dollars. You'll just have more Bitcoins to match that. Or if the price goes up, then you'll have less Bitcoin, but you'll still have the exact same amount of dollars. So in order to go beyond just a hedge and make it profitable, you need to use more than 1x leverage to do that. Now, you want to make sure that you go really, really easy on the leverage. If you go 100x on the leverage, then you could double your account on a 1% move, and you could also lose everything in your account on a 1% move. And you have this feature right here, which is isolated leverage. And how this works is it almost acts like a stop. So if I were to go, if I have a couple of dollars in my account, but let's say I were to use low leverage. Let's say I didn't go a full, use my full capacity of leverage, right? So as an example, imagine I had $1,000 worth of Bitcoin in my account, but I only, let's say I short $300. So I'm not even using one-to-one leverage. Well, if I wanted to isolate that as a stop, I could use what's called isolated leverage. And let's say I went 10x on that isolated leverage, it would treat this $300 as if I'd gone 10x on the leverage. Even though I'm not even one-to-one leverage, it would isolate and treat that as if I'd gone 10x. So if the market moves against me a certain percentage, it'll automatically liquidate and close out that specific position. And what this will do is it can protect your main account. For the most part, I just use cross, and I just generally use the leverage that I want. Cross allows you to set whatever leverage you're capable of using. So let me show you an example of perpetual swap. Now I deposit a very small amount of Bitcoin in here, just a couple of dollars, but I'll show you how to short. So just like other exchanges, you have your limit, right? So it'll only execute at a specific price. So if I wanted to limit sell at, let's say 1070, wait for the price to go up, and let's say I limit sell 3 contracts, so that would be shorting. So it'll show my active order right here. So it'll show the quantity of contracts that I want to sell, the price, the order value, and then the type and the status, right? And of course, I could just cancel this at any time to cancel order. So that'll set a limit order. But let's say I wanted to execute really quickly. So I'll use BitMEX a lot for scalping. Oh, and the interesting thing too is that when you market make and set orders on the book, you'll actually get paid fees. If someone executes your order, you'll have to pay fees. So, sitting orders on the books, market takers, people take orders off the books, have to pay fees. So, sitting orders on the books, that could be a way of generating some passive income. Now, let's say I just wanted to short immediately. I'm just going to short I'll short 2 contracts, right? So I'll just set a market order. So that shows me that I shorted 2 contracts, shows me the price, the value, right? The mark price. So this is based kind of like on a weighted average across exchanges. And then it shows me my liquidation price for where the price of Bitcoin has to go. So obviously I have no risk of liquidation right now. It would have to go extremely high. And then it shows me my unrealized profit and loss, which is so minuscule right now, it's not really showing anything because it's only a couple of dollars. And so you could close out your position. And if you want to close it out immediately, you just hit here as a market order. And that'll immediately close out. So I wanted to use some leverage on this. So let's say I short 10 contracts, which would be equivalent to $10. It actually shows me how much leverage I used on that right here, right? So it's showing that I used 4.79x leverage on that trade, right? So obviously, like the liquidation price now is lower. So if the price hits 1330, I get liquidated and I lose what's in my deposit account. So I'm just going to market close that. So that's how you would short. And longing is just doing the opposite with a buy order. Now, here's another type of contract. Let's say you didn't want to play the maintenance fee games. I mean, if you were in a nice short position, that could work in your favor because you could collect fees on it. They also have these March 31st contracts right here, and these are interesting. So these expire. So instead of a daily swap fee, there's no fee except for executing the order. And they have an expiry date. So these expire on March 31st. So whatever the price is on March 31st is where my order will get closed at. Now, you don't have to hold your orders till then. I mean, you can buy and sell as much as you want between now and that time, but it does have an expiry, right? And so now you could see other markets as well. This is like the Bitcoin yuan if you want to trade Bitcoin against the yuan, or if you want to trade Bitcoin against the Japanese yen. This Japanese yen has 100x leverage. With the yuan, they have 100x leverage. You can play with altcoins. So as you can see here, this is Zcash. It behaves just like buying and selling regular altcoin markets. The only difference is this isn't spot, so obviously you have to be mindful of leverage and liquidation stuff. So it does come with more risk than just trading altcoins on the spot markets, because with spot you could end up bag holding, but you'll still get to keep your coins. Whereas with futures contracts, if the markets move against you and you bag hold, you could lose everything that's in your account and get nothing. You actually don't control any coins. These are just all synthetic contracts. But because there's not enough liquidity in a lot of these altcoins, they offer much less leverage. So they're not going to give you 100x on an altcoin market that doesn't have the same liquidity as Bitcoin. So, and this expires March 31st, gives you 5x. Ethereum expires every 7 days. A little more liquidity, a little more leverage, 33.33. Ethereum Classic every 7 days, 20x. Monroe's 25x every 7 days. You can see same value unit measurement as just trading on the spot markets. And it'll show you all the recent trades here. As you can see, you have nice charts here that you can use. You also have like order history. It'll show me all my orders that I just executed. Stop orders, which behave the exact same as any other stop order. And again, stop orders are used to kind of protect you, to get you out of bad trades. Every 7 days for Ripple, 20x. Then you've got Augur, 10x, Litecoin. So these are all 7-day contracts, 33x. Factom, 20x, Dash, 20x. And then now and again, they have these speculative instruments. Like you can bet on whether or not you think the Bitcoin ETF is going to get approved. So oftentimes they'll have these novelty speculative contracts or instruments for certain types of events. So they are quite unique. BitMEX definitely does have the best trade engine. I've never had BitMEX freeze on me during trades. I use BitMEX predominantly for scalping, just because they have such fast execution and because the fees are fairly low as well. So that's it for this tutorial, and I'll see you in the next. Cheers. Managing emotions is something that many traders have the most difficulty with, because unchecked emotions can sabotage your trades by exaggerating your perspective of the markets. Oftentimes, traders are their own worst enemy, and you could have the best trading plan in the world, but can you execute it without your emotions sabotaging that trading plan? In order to get mastery over your emotions, it requires experience and self-awareness. And you don't want to suppress your emotions, but you want to balance your emotions out by remaining self-aware, objective, and always having a plan ahead of time. So one way to create a plan is that you acknowledge the risks ahead of time and size your position to reflect your emotional capacity. One mistake that many traders make is they go too big on their position size, and then they can't emotionally handle the stress because the risks are too big for them. All right, so here are 3 common enemies of trading. We have fear, which is the fear of loss or the fear of missing out. The fear of loss means that you won't stay in your trade long enough to be able to take the risk of the reward. You will cut out of your trade ahead of time. You won't let your winners ride. The fear of missing out will tempt people or tempt traders into jumping into a bad trade and buying high. Greed will prevent traders from closing out their trade and taking profit or adding too much to their trade too late in the game. So greed can really mess up your exit and timing. And then impatience. Sometimes it requires a lot of patience to be able to find the right trade setup and not overtrade the market, but also be able to ride your profits or wait for your trade to come to full fruition and not cut out of them too early. So here are 7 virtues of the trading warrior. The reason why I use the archetype of the trading warrior is because the markets are a battlefield and it requires self-discipline and awareness to be able to manage your emotions and execute your trades effectively. So here are 7 virtues that you can cultivate to get to that point. First and foremost is honor. You want to make sure that you have ethical guidelines and boundaries for how you make your money and that you don't make money dishonestly or unethically. Courage means acting in spite of fear. So you always have a little bit of fear in the market, and a little bit of fear is healthy. So you don't want to suppress it because that's what's going to keep you alive in the markets. But you want to act in spite of having fear, not let fear paralyze you from pulling the trigger on your trades. You always want to make sure that you have diligence when entering into a trade, that you've looked at both sides of the markets, that you understand the risks and the fundamentals as well. Patience, the patience to not overtrade the market, the patience to be able to let your trade cultivate to full fruition. Determination, you're going to make some mistakes along the way. Determination is your ability to get up. If you didn't have any determination, then you wouldn't have never learned how to do anything in life, because oftentimes when we're learning, you're going to make some mistakes and there's going to be certain pitfalls. So you want to minimize the risk on your mistakes and make sure that you have the determination to persevere. Responsibility, when you take a trade, you need to take full responsibility of the trade ahead of time and after the trade. And so if anything wrong happens in the trade, you want to make sure that you've managed risk, and if you lose money on a trade, that you take full responsibility and that it's not the market's fault. And then finally, the last step is equanimity, and this is when you come to a point of self-mastery as a trader, when you have a calm and balanced mind and you can execute a trade without letting your emotions control you, and you've been able to do all these things. So this is the final stage. So in order to become a better trader, you can reflect on your trades by keeping a trading journal. In this trading journal, you can put in your plans, your charts, your reason for entering into a trade. You could also put the result of the trade and ways in which you can improve it. So if you do this with your trades throughout the year, then you can look back and see what mistakes you've made and how you've been able to improve moving forward. All right, so before putting money into any particular coin, you want to make sure that you do your research. So there's a general checklist that you can go through in order to be able to see the fundamentals behind a particular coin project, because we are also dealing with technology, right? See, crypto in and of itself, it's not just money. It's kind of like a hybrid of many things, right? We're talking about money. It can be an asset or commodity. It's network. It's software. It's ledger. It's all these various different things. So it's kind of like its own particular category in and of itself. So here are some things you can do when you're researching a coin. Most new coins are listed on an announcement thread. They're called AND threads, and you'll see this over on Bitcoin Talk, right? So there's a site called bitcointalk.org, and you can basically look at the announcement, and in this it'll talk about the various technological specifications. You know, what is this coin having to offer, and you can look at market capitalization, so you can see how much room does this have to grow. Is this coin undervalued? And so what the market cap is, to simplify it, it's just the supply multiplied by the price, right? So obviously Bitcoin has the highest price based on its supply, so it has the largest market cap. And then it's also important to look at things like supply distribution, right? Does it have a fair distribution, or is the distribution centralized? Do the developers control a majority of the supply? If they control too much of the supply, then it becomes difficult to be an investor or a trader in it, because we don't know if they're just going to dump on the markets, right? At the end of the day, you're just competing against other participants in the market. And if someone controls, let's say, 50% of the supply of a particular coin, that is very hard to compete against that, especially if it's a coin that it really didn't cost them anything to create that supply, right? So, a developer can just launch a blockchain or cryptocurrency, arbitrarily give themselves a certain percentage of the supply, and it doesn't cost them a cent to do so, right? So sometimes during, ICOs and things like that, you might have a certain percentage that they keep for their development, but if that percentage is too high, then you probably want to stay away from the coin. And then rate of inflation. So rate of inflation is the amount of coins that are created every day on the network. So if the rate of inflation is really, really high, then chances are it's likely not going to be a very good store of value, because that inflation is going to erode its purchasing power, right? Because essentially the value is pretty much determined by supply and demand, right? And if the supply is much greater than the demand, then the value goes down. But if the demand is greater than the supply, then the value goes up. And it's also important to look at trading volume, as we mentioned before, liquidity, right? So you can basically adapt your specific type of trading strategy based on the volume, right? High volume markets might be good for breakout trading, whereas low volume illiquid markets, not so much. They get a little bit more spiky. And then you also want to make sure that a coin or project has active development and community, right? Because like mentioned before, value is only determined by community support and its participants. If a certain coin or project has a very weak community or no community at all, then it's not going to have much longevity. And if it has no active development, we call these dead coins, then chances are they might get delisted, and it's also going to lose community support. So you want to just make sure that you're not trading anything like that. And then news events. The interesting thing with these markets is that news events generally affect the price, right? You could have like a bullish news event and a bunch of people will start chasing the price, and the price will start to move up, right? So, people say that everything is kind of priced into the market, efficient market hypothesis. But what I've seen with crypto is that this isn't really applicable. You get a lot of what's called last minute shoppers, people who just trade purely based on news events. And, they'll just start chasing price. And if it's a big enough event, it could actually trigger a huge rally. All right, so ICO research checklist. So ICO stands for initial coin offering. You see, the interesting thing about the crypto industry is that it's very easy for people to crowdfund. We're predominantly dealing with open source software, so it's very difficult for companies to be able to monetize this. Oftentimes when open source project is released, anybody can copy it, anybody can participate in the network. That's the open source element is truly what kind of makes it decentralized. And as a result, often you'll have like a token sale or a token exchange where someone will create a certain supply of tokens for the network. And usually they have utility on the network. They can be used as gas to be able to create certain contracts, or perhaps for fees and things like that, or to help secure the network, such as Bitcoin. And so what people will do, and this is not all projects, some projects are called what you call like a fair launch, which is just they just launch it and anyone can start mining from ground zero. And with ICOs, big projects like Ethereum, what they'll do is they'll raise funds for development so that they can work and have a job to contribute to the open source community, right? And so oftentimes these can be profitable and sometimes not, and sometimes there are ones that are outright scams. So there are a couple of things that you want to look for if you want to participate in one of these ICOs. Number one is innovation, right? Is the project offering anything new? Is there any real reason to contribute money to this particular project? Because we are dealing with open source. There's a lot of copycat projects out there where people just kind of copy and paste code and then try to raise money for it. But what are they really offering as far as innovation beyond marketing hype? Now, some of them will actually make a lot of money regardless. You know, a lot of them will raise money even if they are just kind of copies of other projects. But for the most part, you know, you really kind of want to make sure you're looking for projects that are offering something new to the ecosystem that other developers can build on, right? Also, look at the project team. Check out their reputation. You know, did they contribute anything over on GitHub? Do they have any prior business experience? Do they have a good standing reputation in the community? Or are they just some, you know, anonymous developers you've never heard of before? That have no reputation or that have a shady reputation. So you want to, or no business experience, right? So you want to make sure that it's got a solid team. Usually the bigger the team and the better the reputation, the more successful the project's going to be. But even if you have a really solid team and innovation, you really want to look at pre-market saturation, right? Because sometimes what will happen is that if the project is extremely innovative and the team is really, really good, people get extremely excited, and what happens is you can end up in a pre-market bubble, right? Where the price, you know, there are certain models out there where they'll say, okay, we have a certain amount of supply, let's just call it, for example, 80 million coins that we're gonna, or tokens that we're gonna be selling, and we won't have a cap on the amount of money raised. So if they don't have a cap on the amount of money raised, then that means the cost per token is going to be high if there's a lot of participants. So the more participants that come in, the higher the cost of the token is, right? If there's too many participants, then you end up what's in a pre-market bubble, right? And if you're in a pre-market bubble, it means that all the buyers are in pre-market and the price is really, really high. And it means when this token hits the exchanges during price discovery, there are no buyers left, right? And so the only place for that coin to go is down, right? So you want to really kind of pay attention to the market saturation. And then community sentiment, right? What's the community saying about it? Is anybody calling it out as a scam? You really want to look at both sides of the coin, and even, you know, use Google and put the coin project in beside the word scam and see if anybody has any critiques on it and really look at it objectively. Now, sometimes people are just trolls and they'll just cry wolf for nothing and say everything's a scam and get exaggerated. So you really have to kind of differentiate legitimate concerns versus people who are just used to trolling or against a particular project because they happen to be a part of another crypto community.